Hey there, Brad Castor from GreatOptionTradingStrategies.com. As an option seller, primarily selling puts, but I'll also sell naked calls or bear call spreads when conditions are right, I've learned to adopt a certain mindset. I call it heads we win, tails Mr. Market loses. Now that's the difference between option sellers and option buyers. Buyers have to be right about what a stock is going to do, when it's going to do it, and hopefully how hard it does it. If they're wrong on any of those, they're probably going to lose money. When you sell options, however, things are much more flexible and forgiving. At least once you learn how to structure and manage your trades and really exploit the inherent advantages in selling options. Now, heads is easy. I sell a put on a stock saying it won't go below a certain price by a certain date. Sure enough, the stock doesn't trade below that level. The put expires worthless, or I buy it back early on the cheap, and I walk away with really nice high annualized returns over the near term. But tails is where things get interesting. True, the returns aren't as good in these scenarios, but I've always gotten a certain guilty or sick pleasure taking what should have been a loss and walking away with more money than I started with, and frequently at a rate that's still okay to decent. So in this video, I want to show you one of those examples, but I want to do a little more than that. That's because I'm a firm believer in the idea that the best option trading lessons come from the trades themselves. So there are a couple of additional insights that this trade provides, and I'll go over those too. Okay, let's jump in. Now this is a put selling trade we did inside my private membership site, the Leverage Investing Club, back in the spring of 2022 on BK, Bank of New York. We sold puts at the $50 strike, essentially betting Mr. Market that he couldn't push BK below $50 a share before expiration, which was only about 3.5 weeks away. If all went according to plan and the short put expired worthless, it would have been a nice 24.74% annualized ROI over 24 days on $5,000 of cash secured capital per contract. Now, unfortunately, things didn't go according to plan, so heads we win was off the table. But that's okay because this is where tails Mr. Market loses comes in. Now, hopefully you can make out the numbers on the spreadsheet here, but we'll go over them so they should make sense. Before we get started, I just want to say that yes, all the net premium figures reflect the commissions and fees that I paid. Okay then, in leg number 1 to start the trade, I sold that initial April 14th $50 put for 82 cents a contract when BK was trading at $52.49 a share. Fast forward to a couple days ahead of expiration on April 12th, and the stock was trading at $48.43 a share. And it was time to start managing and repairing the trade. On leg number 2, I simply rolled the $50 short put out 1 month to the May 20 expiration cycle for a $1.15 net credit. That means I collected $1.15 a contract more for setting up the new leg than what it cost me to exit the old leg. I paid $1.79 a contract to buy back my April $50 put, but I received $2.94 a contract when I sold the replacement May $50 put. Unfortunately, the stock continued trading lower, and by the time I needed to make my next move, BK was then trading at $43.80 a share. That brings us to leg number 3, where I rolled the $50 short put out another month to June. But this time, because the position was now this deep in the money, I only collected a 15-cent net credit. I bought to close my May $50 put for $6.31 a contract and sold to open the June $50 put for $6.46 a contract. Now, before we continue, let me just interject something here. Our trade management and repair process doesn't simply involve us mechanically rolling out an in-the-money position and just hoping that it comes back at some point. When a position trades in the money on us, in this case when BK traded below $50 a share, we actually want to work the strike price lower. But only if we can get a net credit on the move, and only if we don't have to roll it out more than 3 monthly expiration cycles to do it. Unfortunately, we weren't able to do that with this trade, and we'll come back to this because that's actually one of the little bonus lessons inside the trade, why we weren't able to do that. Okay, back to the trade where we finally have a little good news. The stock rebounded some, and by the time I needed to roll again, shares were at $46.15, and I was able to get a better net credit. This time, leg number 4, I rolled the position out 3 months from June to September for a $1.25 net credit. Paid $3.93 to kill the June $50 short put and received $5.18 a contract for selling to open the September $50 put. Now with leg number 5, things get a little complicated, but nothing we can't wrap our heads around. I was actually assigned the shares in August because the time value on the September $50 short puts had gotten so low. Now, this is kind of a conversation for another day, but being assigned on a short put position isn't that big of a deal. We have a process to deal with assignments that I call, appropriately enough, unassignment. I also have a 3-part series on early assignments, what they are, how to avoid them, and what to do if it happens to you on the Great Option Trading Strategies website. If you want the link, just ask down in the comments section and I can get it to you. In any case, I held on to the shares for about a month before making my next move because I felt Mr. Market was sort of at a crossroads with the stock. I wanted to see whether the stock would hit $45 a share or $40 a share first. If the stock traded back up to or above $45, I would just continue selling those $50 puts. But if the stock traded down to or below $40 a share, I would add a second contract and work the strike price down to $45. That's based on something I call the double half principle. By doubling the number of contracts, I can effectively cut in half the distance between my short put strike price and the current share price. And that's exactly what ended up happening with leg number 5. On September 23rd, with BK trading at $39.41 a share, I sold my 100 assigned shares on the open market and then sold to open 2 December $45 put for $6.26 a contract. When the dust settled, I had not only worked the strike price down from $50 to $45, but I also scored another $191.68 of additional net premium. This isn't witchcraft, I promise. I paid $5,000 for those shares when assigned, and then I sold them for a loss at $3,941. But I also brought in $6.26 a contract of new premium with the December $45 short puts, or around $1,250. Even better, the stock would no longer need to trade back above $50 a share for me to be out of the trade with all my profits. I just needed it to get back above 45. And that brings us to the 6th and final leg. BK came close, so very close to getting back above that $45 level, but with just a few days left before expiration and the stock still a little short, I felt there was a risk shares might start drifting lower again. And there was a move that was available that I really liked. So on December 12th, with BK trading at $44.74 a share, I bought to close my 2 expiring December $45 short puts for 85 cents a contract and then sold open a single January $45 put for $1.70 a contract. I basically rolled out 1 month but reduced my contracts back down to 1. It was a flat roll where I basically just paid commissions. Now, I could have rolled both short puts straight out and collected a very nice 85-cent net credit for each contract. But remember, this is a tails situation, and I'm trying to repair and improve the trade and get out of the trade. And this move allowed me to take a lot of the risk out of the position, and it really set me up nicely if I needed to continue repairing things, because at this point, I was back down to the original 1 contract size of the trade, at a 10% lower strike price, and I also had a nice pile of accumulated net premium. Mercifully, the stock did finally get over that $45 share price hump, so that on January 9th, or about a week or two before expiration, I saw that I could exit the final short put for just 20 cents a contract, and I jumped on it. On that last leg, factoring in the previous flat roll when reducing the contracts, plus the final 20 cents a contract it cost to close the trade early, and the various fees and commissions, I lost a small amount, but it was for a good cause, and I ended up netting 8.31% total returns, or 10.25% annualized over 296 days. Now, you're not supposed to be impressed by the final returns on their own. What you're supposed to be impressed by is that we were still able to generate double-digit annualized returns selling puts on a stock that completely went the wrong way on us. At the point we exited the trade, BK was still $3.86 a share, or 7.35% lower than where it was when we originally entered the trade. There you have it. Heads we win, tails Mr. Market loses. Okay, so what extra lessons did this trade have to teach us? First, the width of the BK strike prices themselves were a headwind for us. Now, I didn't mention this at the time, but regular BK monthly options at the time of this trade were priced in $5 increments, as in the $50 strike, the $45 strike, the $40 strike, etc. Without a doubt, key factor that slowed our progress were those wide strike prices. Every time we touch a trade, we should be collecting more net premium. And the more we're able to lower the strike price along the way, the easier and more lucrative all future rolls and adjustments will be. And the quicker we'll be out of the trade too. But when you have the chasm of a $5 strike price to overcome, it becomes very difficult, if not impossible, to roll down and out to a lower strike for a net credit in 3 months or less. Had those options been priced in a little friendlier $2.50 increments, I have no doubt we could have lowered the strike without needing to add contracts, and that we would have been out of the position earlier and with better final results. So what we were basically left with was straight rolls for net credits, or getting paid just to tread water, or adding contracts if the stock really sold off. And lesson number 2 is that reducing the size of your position, especially if you can also collect another net credit, or at the very least it doesn't cost you anything, is a creative way of reducing risk and continuing to improve the trade if you're close to repairing it, but you're not quite there yet. But if I had the choice of reducing my contracts or rolling them all down and out to a lower strike for a net credit, I'd choose to work them all down to a lower strike. Okay, if you have any questions about anything or would like me to clarify anything, please let me know in the comments below. And if you enjoyed this and would like more option selling resources, you might want to check out my Great Option Trading Strategies website. Link in the description below. The site has been around for 17 years now, and you're not going to find a more comprehensive collection of free, quality option trading resources. From downloadable special reports and trade case studies to hundreds of articles on selling options for income, as well as incorporating options into value investing and dividend growth investing portfolios. Best of all, no annoying pop-up ads, and you're also not going to get spammed every time you turn around. There's also a contact form on the site if you want to reach out directly. Okay, until next time.